Shell published its Q2 2026 trading update this morning, and the headline figure was striking. Integrated gas production fell between 610,000 and 650,000 barrels of oil equivalent per day in the quarter, down from 909,000 BOED in the first 3 months of the year, a drop of roughly a third. The reason is a single facility, Pearl Gas to Liquids in Qatar, one of the world's largest GTL plants, which stopped producing in March after an attack on Ras Laffan Industrial City. It has not restarted. Every day of Q2, Pearl sat idle. Yet Shell shares rose 3.1% to around 3,002p by mid-morning. That is the paradox this update creates. A production collapse of that magnitude would ordinarily weigh on any energy major. Instead, investors mark the stock higher. The reason sits in a different part of the update. Shell's gas trading and optimization profits are guided to be significantly higher than Q1, and Q1 was already exceptional, with chemicals and products adjusted earnings surging to $1.925 billion from a $66 million loss in the fourth quarter of 2025. The war that destroyed Pearl's output simultaneously created the market volatility that supercharged Shell's trading desk. The bottleneck is not the production shortfall itself. It is whether trading profits are a real earnings substitute or a one-cycle windfall that reverses the moment the Strait of Hormuz normalizes. That question is what the today's update leaves open, and it is the question that decides whether 3002p is an entry or a ceiling. Pearl is not a standard upstream asset. The Qatar facility converts natural gas into synthetic fuels, diesel, naphtha, lubricant base oils, through the gas-to-liquids process. Its output carries higher margins than raw LNG because it bypasses the standard gas-to-power conversion chain and produces refined liquid products directly. The facility can run at 140,000 barrels per day of GTL products at full capacity, and Shell has owned and operated it for over a decade as one of its most capital-intensive assets. When Ras Laffan was struck, Pearl did not simply dial back output, it halted entirely. Shell raised the top of its LNG liquefaction guidance slightly to a range of 7.4 to 7.8 million tons, but that adjustment absorbs only a fraction of the Pearl shortfall. The working capital effect is also visible. Shell guided a cash inflow of $1 billion to $6 billion in Q2, after an $11.2 billion outflow in Q1. Part of that improvement reflects favorable commodity price movements on inventory, not the underlying production recovery. The contrast with the trading desk is sharp. Shell's integrated gas trading profits are described as significantly higher than Q1. Brent crude reached above $120 per barrel in the weeks after the conflict began, before settling back to around $72 to $73. That arc, extreme spike, partial recovery, persistent uncertainty, is precisely the environment in which a global energy trading operation generates its highest returns. Wide spreads, volatile differentials, scarce supply, and uncertain routes all create arbitrage opportunities that a smaller trading book cannot exploit. Shell, as one of the world's largest LNG traders, can. The uncomfortable implication, Shell's Q2 earnings improvement is built on the same event that stopped its most valuable Gulf facility. The two stories are not independent. They are the same war, measured twice. The bull case on Shell today rests on a single structural claim: that Shell's global trading and optimization business is large and diversified enough to durably offset production volatility. This is not an unreasonable argument. Shell Q1 2026 adjusted earnings came in at $6.9 billion, beating consensus despite the Pearl shutdown. The trading desk drove much of that outperformance. Q2 is tracking similarly. If trading can deliver this across 2 full quarters of Hormuz disruption, the earnings floor looks real. But that floor is built on an assumption the market is pricing as permanent, when it may be temporary. RBC Capital Markets said last week that ceasefire reports were running well ahead of reality. The bank's commodity team cited war risk insurance that has not dropped, military escorts still required, and transit lanes in the strait effectively one-directional. Today, a report of an LNG tanker being struck while exiting the strait pushed Brent up a further 1% to $72.68. The waterway is still not a normalized shipping lane. That keeps Shell's trading margins elevated. The moment transit conditions genuinely stabilize, the dynamics reverse. Brent falls toward the $70 to $80 range that JP Morgan has flagged as the reopening scenario. Trading spreads compress. The arbitrage opportunities that drove $1.925 billion in chemicals and products earnings in Q1 diminish. Shell's production, assuming Pearl restarts, recovers in volume but at lower unit prices. The question is not whether the scenario arrives, but when and how fast. The hidden assumption the current share price embeds that trading profits persist at or near current levels while production eventually recovers, giving Shell a sum of both parts outcome. That outcome requires the strait to remain semi-disrupted for long enough for Pearl to restart without the trading premium fully deflating first. There is no guarantee those two events arrive in that order. Shell's full Q2 results are due on 30 July 2026. That release will provide definitive earnings, confirm the next share buyback, and update dividend guidance. For holders debating whether to trim at current levels, and for watchers deciding whether to enter, that date is the obvious checkpoint. But the more discriminating signal arrives earlier. Daily transit counts through the Strait of Hormuz are publicly tracked. Before the conflict, the waterway handled roughly 90 transits per day, the highest single-day count since the U.S.-Iran Memorandum of Understanding was signed, reached 59 on June 24, before falling back. This week's rate stands at 20 to 25 ships per day, with most movement inbound rather than outbound, as shippers wait for conditions to stabilize before committing to Gulf exports. A sustained move towards 60 or more daily transits, with outbound flow recovering to match inbound, would signal that insurance costs are compressing and that the trading premium that has driven Shell's Q2 performance is beginning to deflate. That transit signal prints daily, weeks ahead of Shell's July 30 results, and it governs the earnings trajectory more directly than any quarterly figure. The counter-evidence is not absent. Another LNG tanker was hit in the strait today, and Iran has required ships to use a northern route closest to its coast, making navigation slower and the risk premium structurally higher. That keeps Shell's trading environment intact for now, but the ceasefire talks in Doha are ongoing, and an agreement that materially reopens the waterway would compress Shell's trading margin faster than management or consensus has modeled. For a holder, this becomes an entry setup if the July 30 results show that LNG production has restarted at Pearl and trading profits are still running ahead of consensus. Both conditions holding at once would confirm the sum of both parts thesis. It becomes a trap if transit counts recover towards 60 before Pearl restarts, compressing trading margins before production volume compensates. The Hormuz daily transit rate is the variable to track before the July 30 print, not the Brent spot price. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.